Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, findingvalue.com. I dive deeper into all these topic subjects, looking for potential investment opportunities, sharing those opportunities with everyone in the community. We mainly have midweek updates released on Tuesday night, early Wednesday. And then we've got question and answer sessions on the weekend. I do have some stuff that is uploaded to the website that is training, like technical analysis training, Elliott Wave. There's a couple of those things on the website. We do have a Discord as well if you want to share with other members, and I'm also on there myself. So the main value, though, I would say, are the midweek updates and the Q&A sessions that you can ask me questions directly. We also go over companies. We do conference calls and stuff like that during some of those Q&A sessions. Special is the coupon code if you want to use to get a coupon. It's special. So Peter Brandt says crude oil completed a massive descending triangle on the 57 chart, rolls to most active contract. This pattern has a target of sub 40, negated above 72 for now. I'm willing to short it at 63.50, he says. So I see a lot of these calls out there of you get a breakdown in oil and then it's a good time to short. I don't know what they know about oil. We are below the upper cost curves of oil. We have low inventories. The fair value based off commercial inventories is about $20 to $25 undervalued. This is a pure technical approach, and I think it's highly dangerous to take this mindset and apply it to the market. I see a lot of people calling for $50 oil, $40 oil. This one in this particular case is 39.11. And we do have a small breakout potentially of the lower trend line. So this is the way that I see it. So when I look at it, this is what I see. I see a three-pump consolidation, which is this whole area is your consolidation of a recovery phase of real estate. So it's this whole region in here. We broke out of that consolidation and are sitting on top of that pattern. So if you were to short it, it could get to 50. I mean, that is a possibility. You're going to get strong support at that general region. But your risk reward here is not that great, in my opinion, unless they absolutely tank the markets somehow. I'm not in that camp. I think that where we are today is the same as it was back here, or very similar. This is almost the same pattern that he's got. It's this pattern right here. This is back in 2000, 2001. We had a peak, a pullback. This pullback is smaller than the pullback that we have experienced just recently. So even if it broke down here, he's saying, well, I'd short it when it gets down to 23, and all it got down to was about 18. And then what happens is you create a slingshot. A lot of people get short because it broke this little thing, thinking that, it's going to go way down. And then it slingshots and squeezes all those shorts to the upside, moving on higher. This is what I think is coming with time. And a lot of people say, well, you don't know exactly when it will come. It doesn't matter, guys. The risk reward here is so big to the upside that that's what I play. Another thing here is you have a three-hump consolidation. That was your previous consolidation from 1986 to 1999. So you have a three-hump consolidation, breakout, retest, go. We have the same exact fractal: 1, 2, 3, breakout, retest, go. It's difficult to know that you're going to get a false breakout or not at these turning points. We also have a wick at the bottom here, which means there was some buying pressure towards the end of the day. If you look at how this is being traded, this is pre-market, market open, pre-market, market open. So it's bottoming or trying to turn during the open market, and then they slam it pre-market or post-market. I do think that there are motives to get the oil price down to try to get the 10-year yield down because there's a combination there. I don't know how long this will last. We're below cost curves. I think we're actually going to see a decline in oil production if oil prices stay anywhere near where we are at today. And it could be a big decline. It could be 500,000 to 1,000,000 barrels a day in certain, around the world. So to make that bet that you're going to go short, I don't see a ton of reward there, but it's possible. I think all you're going to get is maybe down to maybe 50 at best. 55, it's not a big risk reward. I think the upside over time and with the inflation that's coming, I think it's a much better play to the upside. My opinions only. Doge Patel says, talked with a few friends this evening who are in different company sectors. Basically, if they don't provide some clarity this weekend on the tariffs, show some movement based on negotiations, we are heading into a recession. From Monday, companies are talking firm actions to deal with the impact of tariffs. A lot of companies are in FY 256 planning cycles right now. They have already paused all hiring, cut top-line projections, and layoff lists are getting drawn up to preserve at least some EBITDA. The market reaction is totally justified. It's not a tantrum. Yeah, so with the uncertainty wrapped around these tariffs and what could potentially happen, and people, it's really just uncertainty is what I'll say. You're seeing companies take action here. And you could lose a lot of jobs. There could be jobs that are cut because of the tariffs. I thought tariffs, the sole purpose of tariffs, I thought, were to create jobs, American jobs. But if the way that you implemented it causes a bunch of people to lose their job, I mean, that kind of defeats the purpose, right? To some degree. And maybe we need a restructuring of our economy. I don't know. Maybe that's the case. Unusual Whale says, breaking, hedge funds are facing layman-style margin calls due to the market crash triggered by President Trump's tariff per Daily Mail. So it looks like margin calls are going to amplify the selling pressure. So we saw pretty large selling pressure, pretty deep for 2 days. I mean, that was a pretty big pullback. For a 2-day pullback there. And this is driving a lot of it, these margin calls. Oilprice.com says, from all the market commentary I've read today, Oaktree co-chairman Howard Marks' comments might be the most accurate one at this very moment. So let's read this little statement from Howard Marks, who's a pretty famous investor from Oaktree. That's quite a statement coming from Marks, a nearly 50-year veteran of financial markets and a leader in distressed debt investing who has pretty much seen it all. Marx said the tariffs have unleashed a cascade of unknown and unknowable factors for investors to consider while trying to figure out where to put their money. That's because they can't predict the future of U.S. fiscal policy, let alone how other countries will react. That's completely true. And up here, it says, Marx said, global economy was shook up like a snow globe by the events of the last days, and that we know much less today than usual about what to price into investment decisions. That's what's causing the problem. It's the uncertainty, the unknowns, and how other countries may react to these unknowns. So I'll just put it this way. The markets have panicked because there is so much uncertainty and fear about what is not known in the market. Also, this is a man-made or a man's decision to apply this to the markets without really giving much heads up before doing it. And then he applied it to everybody. It wasn't like they applied it to one country or they were in the talks of trying to deal with a country, and they applied it to one country that was being unfavorable, however you want to say it. He just went out there and freaking winged it. He just winged it, which is weird. Coming down, we have a retest for gasoline. So we've got gasoline here, the 3M consolidation squeezing up. We've got a breakout of gasoline. It looks like we're doing a retest here, potentially. And I'm sure they're trying to drive this down. I'm sure they're trying to contain this. But we had a breakout before that. That was positive for oil. Gasoline breaks out first. That's kind of your leader. That's closest to the consumer. And then it rolls on back into oil and other products. The gold to SPX ratio, S&P 500. So gold to S&P 500 performance from gold being freely traded. So we had, this is the S&P 500 making these movements back here. From 1960s forward, it was freely traded. I should say 72 forward. You can see an outperformance of gold versus the S&P. We're kind of squeezing into this corner here in a falling wedge. Falling wedges are generally bullish to break higher. Recently, if you look at the little tip there, gold's been outperforming SPX, and we're getting a breakout. So I think that this has a possibility of breaking out of this falling wedge and going way higher. What does that mean? Well, the only thing I can think of, and the way to describe it, is that we go into a resource-constrained world, and that gold outperforms most everything, gold and silver and some of these other precious metals, platinum, because of inflation and energy constraints and maybe other resource constraints like copper or something like that out in the future. And maybe that's starting right now. Here's the outperformance. I see a lot of posts where they compare gold and the S&P 500, and they go all the way back to like the 1800s when we were on a gold standard, and gold was held low for a good chunk of that time. So what I did is I went back to 1971 or so and said, well, what about when it was freely traded? Gold's outperformed the S&P dramatically since it's been freely traded in 1971 and 2. So that's kind of where I started it, and that's where it ends up. This is starting at 2000, the market low of gold, where I think that it came into cycle. We have a big move, a consolidation. During this consolidation, that's when the S&P 500 went up. It was 2009 all the way up. That's your cycle that you want to go into for the S&P 500. The cycle here is all gold, silver, platinum, oil. Gold goes up, oil goes up too. So even though in the short term, oil's gotten hit and people are bearish on oil, we saw that bearish price projection at the beginning of this clip. Gold and oil generally move together. And this is the cycle from 2009 here. So here's the cycle from 2009 outperforming gold. That's in cycle for the S&P 500 from 2009 to where we are today. In fact, I would say maybe even here was the first rollover, and that's probably where I would have gotten into gold. Another option would have been back here, but these all look great in terms of gold and silver to outperform the S&P 500. Logan says, quietly, with all the noise today, purchase applications are positive year to date and year over year. Our weekly pending contracts are positive year over year. Our total pending contracts are positive year over year. New listings data is positive year over year. We will go over this with the tracker report today. So mortgage purchase applications are up this year in 2025. They are increasing, which is good. This is from Michael. He says, just to put things into perspective, yesterday's Trump crash was worse than the drop when the market reopened after 9/11. So this is the Trump tariff crash, minus 6%, and that was worse than the September 11 attacks, which was down minus 4.9%. I think the volatility has really kicked up since 2008. It seems like the volatility back in the day, outside of maybe a handful of days, 1987 crash, Black Monday, whatever, but these are pretty big moves lower. Pretty big moves for daily moves. The only market comparisons for the last 2 days are the Great Depression, the Great Recession, Black Monday, and COVID. One guy on purpose, still hard to fathom. I know that is, it really is. Here's WTI, big technical breakdown for oil, breaking down from its 4-year wedge. It did find support at its 17-year long trend line this Friday. Trend line starting at the 2008 top there. Interesting to see if it holds here. And there it is. And we've got a trend line coming through here too. It's a small trend line. This is the big picture view though from 2020 into 2021, 2022. And that's how I view it. This is a bullish formation. Now, is this a false breakdown where people are going to try to short it and we slingshot it to the upside? Very well could be the case. It could be a potential false breakdown, and then we slingshot it. It's also possible that we do have further downside if these tariffs stay with the uncertainty out there. This is a really difficult situation because they put it in place and we don't really know much about it. And that's what makes it difficult. It's like, are we going to stay here? Is it going to move? Is it going to come off? Who knows? And how are other countries going to react to it? Is it going to create a recession? There's a whole bunch of unknowns around this. And 100 marks, yeah, we already went over that. High Heat says oil is going higher, gold is going higher, silver is going higher, interest rates are going higher. Above 4 threaten the BIS state the most, which is why they were the target of Liberation Day Black Op. I hate to say this, but I actually 100% agree. Go back and look at each of these and go look where all of the move was created. They all moved massively post-market, pre-market for both days. And then when they opened, it was sideways for oil. Silver, they definitely hit it pre-market. So this is the pre-market, and then this is your market here. It went sideways. Pre-market, they hit it again, and then when it opened, it dived a little bit and was trying to find support. So most of the move was created pre-market. Here's another thing to think about that maybe people aren't thinking about. A lot of these banks are heavily short silver. I mean, heavily short. They're heavily short silver, gold, platinum, and palladium. And what happened to all of these? They all got smoked. If they break out and they run, there is a possibility that causes a bank crisis because they are so short all of these metals. I don't know what happens when they actually break out and run. It'll be a huge short squeeze that occurs in all of these. And maybe that's why they're hitting it. Another thing is maybe they are not successful at getting the yields down or getting oil down. So they went to extreme measures to get these all down at the same shot. They said, you know what? One bird, 5 stone, we could 1 stone, 5 birds, all in one shot. We can take yields down on multiple time frames. We can take silver, gold, platinum, palladium, oil. We can just rip all these in one shot. Maybe it's the case, maybe it isn't. I don't know. But it is highly weird that all of the movements are occurring pre-market. It's kind of weird. Not much volume, they can hit it pretty good. Here's another one, Boltard. He says, so here's the plan. Wait till you hear how brilliant it is. We push stocks lower to force Powell's hand. We cause chaos and people lose jobs. When stocks are lower, he cuts rates. We refinance the debt. We QE to get stocks back to where we were, to where they were, and inflation ramps. Question when? I don't know. I don't know if that's the game plan here or not. It's a tough call because we don't know. It's not like he's going to come out and tell anybody. He's just doing this kind of ad hoc. I've been around the markets a long time. I've seen a lot of crashes on real problems like the GFC or when we didn't know what COVID was. But this is far and away the dumbest crap I've ever seen. Unemployment was 4%, and we were mostly okay, and Trump calls this 20% decline winning. Yeah, I would agree. People saying they told us in advance that this would happen are doing some incredible mental gymnastics to try to justify one of the most haphazardly handled and significant trade policy changes in this country's history. I'm sorry, but nobody told us to expect what just happened. And I don't even think the administration knew what they were doing, given the credible allegations that they used ChatGPT to come up with their formula for tariffs. At the end of the day, the idea that this was all known well in advance is maximally potent copium with no basis in reality. Hate to see people hiding behind the reasoning to give the clown car parade in the district of the criminality an iota of credibility here. They deserve none. I agree. I think this was handled very poorly. And if I were to guess, it was handled so poorly that it was done on purpose to crash markets, maybe, or to reduce the interest rates because of the problems that they have in debt. So, what I would say is, what extent are they going to keep this money or currency system going? I think we have a debt problem. I think it's really bad. And I think they're going to pretty large extents to try to refinance the debt at lower interest rates. That's kind of what it seems like to me. If I were running the country and I wanted the country to be successful, I wouldn't put tariffs on everyone in one shot and not tell anyone that it was coming. What I would do is I would clearly communicate what's coming if I wanted to disrupt the markets as least as possible. And I would have already negotiated with all the countries that I felt were unfair in their trade, and maybe it's only a handful, and only go to the extent that maybe they did if they were being uncooperative. But maybe I don't know, I may not know government dealings and these tariffs. Maybe I don't know enough in the background. Maybe they tried to do that. Maybe perhaps they already spoke with a bunch of them and they decided to just say, screw it, we're going to go for it. Maybe. Howard Marks says the chaos caused by tariffs is probably the biggest change in economic environment I've seen in my career, marking the end of an 80-year period of unsurpassed prosperity driven by free trade. The world was shook up like a snow globe by the events of the last days, and we know much less today than usual. Will the U.S. still be the best place to invest? Maybe. But Marx warns if people don't like the dollar, don't like investing in the U.S., don't want to hold an unlimited number of treasuries, if we just make people mad, the fiscal situation will be very complicated. There's that also, underlying layer underneath here where if you piss people off enough, they might just say, we're not going to use your dollar, screw it. And then we get massive inflation as those dollars come back to the United States. We don't sell a lot. So that would cause a lot of inflation. Today, residential building construction hit a news cycle high. Residential building construction is usually in contraction well before most traditional recessions start. And I think this is a big deal. So this has been going up. And this is your, again, building construction, all employees. This is the leading indicator that I use personally. It's going up. So think of it this way. A lot of what just occurred the past few days of selling pressure, it's not rooted in weakness from the market. It's rooted in fear of the tariffs and the uncertainties around it. So it's two different things. I hear a lot of people talking about we're going to get this big recession. The market is strong right now. It's not weak. That's what this is portraying. The housing market, residential real estate, is a big driver of credit creation and the strength of the economy. So if I were to make a guess, at least in the short term, because there's so many unknowns and uncertainties out in the future, which I can't really comment on, and that's what's causing the market this big hiccup here, is that we're coming from strong footing. kind of like C19. We were strong and coming up in this. We had the shutdown, which was man-made, and then we had a big, huge bounce again because of where we're at in the cycle. I think that we are strong from a cycle perspective. We're very strong. The next question is, what's going to happen with tariffs? And that's where the big question mark resides. If he lifts it, we're going to go flying to the upside because of where we're at and located with this information here. We're strong. The market's strong. So who knows? Who knows what he's going to do with tariffs? This was yesterday. It says, imagine what Peter Tuchman, a 40-year-old Wall Street veteran, has to say after today. And he was pretty pissed off and how the delivery was. A lot of these guys, they've never seen anything like this in their tenure at Wall Street, where they just come out and crash the market like that. TMF OPEC decision is a strong indicator of waning U.S. production, resilient global demand, and a balanced market. Consider that historically, we should have seen more builds than draws. Energy among top performers year to date and asset managers would be wise to add on weakness. And that's what he's saying. Thank you. And I agree. We've been drawing during build season. That's bullish oil, not bearish. We've got maybe $20 to $25 undervaluation to commercial inventory levels. And only the past 2 days has it really kicked us out of that pattern. So was the fear warranted? Is the uncertainty priced in? Is it going to create a slingshot cheetah to the upside where people start to get short and they get squeezed out of it? No one knows. No one knows. And I see a lot of people making predictions. They make predictions. Oil's going to 40, oil's going to 50. And then they're so confident in that prediction. If oil does go down for whatever reason, the reasons that you attribute to that move may or may not be so let's say oil does get to $45 or $50 a barrel. There's more scare in the market. Let's say it gets there. That doesn't mean that if you put a price target of 45 on it, that your reasonings are necessarily right. And if someone else, let's say, goes long in oil and oil prices go way up, that doesn't mean that their reasons are necessarily right. A lot of this is playing statistics and probabilities. And if you get pocket aces, you up your bet based off of what you have. And that's kind of what investing is. You find out what all the information is. You say, okay, this is a pretty good chance to go up. Then you put your bet on. That doesn't mean that you win. But the actions that you took were still the correct actions, even if the result was a negative outcome. And that's where people have to really figure out is where do I go to put on an investment? And did the decisions that I made or make, were they the right decisions, even though the outcome was either right or wrong? And that's where I think people get messed up. They make a prediction, their logic is completely flawed, and even though the outcome could be correct, and even though they made money in a potential trade, it was still a stupid trade that should have never taken place, even though it was a positive outcome. So maybe they put the trade on and it was only a 10% success rate, and they somehow got lucky with the 10%, so to speak, as an example. Rick Rule says, investors and speculators survive or thrive. The choice is yours. It is only when you understand the value of your holdings that the price information matters. Is the price materially less than the value? You buy it. Is the price above the value? You sell. Natural resource investors, the Rule Classroom discusses valuation techniques. That's it. That is true. Here's Holger. He says, in the 25 years covering the markets and tech stocks, we've been through many chaotic markets and crisis moments, says Wedbush's Dan Ives. He says, from the dot-com bubble and burst to the financial crisis to Europe, debt crisis to COVID lows in March of 2020. But never have we, or others that have covered the markets for 50 years plus, seen a self-inflicted debacle of epic proportions like the Trump tariff slate over the last 36 hours. The concept of taking the U.S. back to the 1980s manufacturing days with these tariffs is a bad science experiment that in the process will cause an economic Armageddon in our view and crush the tech trade, AI revolution theme, and the overall industry in the process. I don't know if I necessarily agree or disagree with him, but I do think that the way that Trump came out and conveyed his message was absolutely unacceptable. It's borderline unethical and borderline maybe even illegal to some degree, depending on how they look at certain things with tariffs and taxes and not going through Congress. There's other things in the background of it. But the way that if I didn't want the markets to crash, if I was being an ethical, responsible person, you're supposed to convey what you're doing before you do it. You don't just go out there and surprise the world. Yeah, exactly what he said here. It says this week does indeed feel like March of 2020, as nobody knows what will happen in the markets next. It's probably wise to do what worked in 2020. Stay calm, manage your risk, don't leverage, buy rock-solid businesses in temporary trouble, don't check your portfolio each hour. And there's the economic policy uncertainty index spiking like 2020. This is called a sale, my friend. For those who know the difference between value and price, you don't panic, you pounce. Welcome to the Rule Classroom. Yeah, I agree. That's the decisive action that you need. You find the value of the company, you find your companies, you wait until they become, there's fear in the market, you pounce on it. Yeah, totally agree. But that's where I'm gonna end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. We've got a question and answer session coming up at 5 p.m. Mountain Time on Sunday if you'd like to join. All right, guys. We'll catch you next time. This is Finding Value.